Hi, and welcome to the Stockscores Market Minutes for March 25th, 2013. This week's topic, trade the strategy, not the stock. We'll get into that in just a moment. A reminder that you can subscribe to this YouTube channel and get instant updates anytime I upload a new video. Now, before I get into this week's analysis, here are the dates for the Stockscores Canadian Active Trader Expo Tour. You can see them there on screen, but more importantly, go to the address on screen, that's stockscores.com/skate, where you can watch a little video outlining what skate is all about, as well as see the details for locations and times in the Canadian cities you see here on screen. All right, this week's topics, trade the strategy, not the stock. There's a tendency for investors to focus on the stock, and in doing so, they often focus on the story. But what's really important is what the stock is doing. Most stocks, most of the time, are not worth trading because there's nothing going on that will move that stock faster than the market. We want to trade situations where the trading activity indicates that the trade has a positive expected value. Now, I develop trading strategies, both long and short term, where I have a set of rules that I have tested over a large number of trades, and I know that if those rules are satisfied, I will expect to make money over a large number of trades. Now, I don't know which trades are going to be the winners, but with a positive expected value strategy, you can apply those rules over and over again, and over again, over time, that strategy will make money. You know, a stock can be great to trade one moment and then not worth touching the next. It's really about the situation that the stock is in that makes it important. Let me show you an example to drive this home. MERU was a stock that I featured in my newsletter back in February. And I've highlighted the chart here with some red boxes, which indicate periods when this stock was not worth buying. Now you might say, well, it would have been great to buy it early in February because that's when the stock really went up. However, early in February, the stock had rallied up to resistance and gotten stuck. And at that point, buying that stock did not have a positive expected value. Now, as it turned out, the stock broke out in the third week of February, and that breakout from low price volatility, from optimism, through resistance, the things that I talk about over and over again, well, on that particular day, that stock was worth buying, and for a few days after because it didn't really move sharply higher yet. But as the stock goes higher, you'll notice that I put it into the red box again. And the reason is not that the company isn't a good one, it's that the situation is no longer good. You know, to buy that stock at $5 with support at the red line down around $3.40, well, the risk of the trade at that point was just too high for the expected reward potential. Now, buying it at 4 to sell it at 6, that had a good reward for risk. Buying it at 5 to sell it at 6, now the reward for risk just didn't make sense anymore. So it's not only about what the company is doing, but also what the market's reaction to the company is doing. And that's why you need to trade the strategy and not the stock. All right, let's get into this week's analysis of the markets. It was a bit of an interesting day in the U.S. market today. You'll notice here I've got a daily chart of the S&P 500, and you can see that the market remains in that very linear upward sloping channel, and therefore we can remain bullish because that channel is going up from left to right. And until the green line, the lower boundary of that channel, is broken, I'm not too worried about the market. However, today there was a little bit of a bearish sign, a very short-term one, because the market gapped up on the open, likely because of the positive news that a resolution had been found in Cyprus. But shortly after the market opened, we had a pretty sharp sell-off, and the market went from being up strong to actually being down strong. And that is an important intraday reversal that is, in the very short term, bearish. Now we can also see that the high that the market hit this morning is lower than the high that the market hit back on March 14th. And so we have now a falling top that is built. Now, we don't really have a strong breakdown on this chart yet either, so I don't want to make anyone think that it's time to run for cover, but the market has taken one of those initial steps towards further weakness. And if it continues to make a few more steps, then we're going to have to change our bullish outlook on the overall market. Now here's a chart of the TSX 60, and it has been selling off in the last few days. In the case of the TSX, you had really two markets. You've got the commodity stocks, and then you've got the what I call the boring stocks, the banks, the financials, the telecoms, which have done great. And you know, the TSX, if you look at the chart, you say, well, it hasn't really kept up with the S&P 500. Well, if you looked at the chart of the banks or the telecoms or the rails, you'd say, wow, it's probably outperformed the S&P 500. The reason this index doesn't look that great is that it has been dragged down by the commodity stocks, particularly the gold, silver, mining, and to some extent the energy stocks. And so we've had an underperforming market in Canada, although some sectors of the market have performed great. What's happening in the last few days is that those strong performing sectors, particularly the financials, are seeing some selling pressure, just as they are in the US. And meanwhile, the commodity stocks are not picking up the slack. There's no strong sector in Canada to pick up the slack. And so that's why we've had this, sharper breakdown in Canada than we've seen in the US market. Now that upward trend line is still intact, so we don't have to run for cover just yet, but I did lower my rating to neutral from bullish this week as the breakout has failed on the TSX. TLT is the bond ETF. It remains in a downward trend line, but it is flirting with that downward trend line. And if it were to break that, it's a little bit bearish for the market because it means that investors are a little bit cautious, running for cover, and that could coincide with a breakdown of the upward trend line on the S&P 500. So a little bit of caution warranted with this chart. The gold chart, we've seen gold come up in the last couple of weeks, but it still is in a bearish chart pattern, and I am not yet at all close to being bullish on gold. I remain bearish on gold. I do think it could come up a little bit more until it touches that downward trend line, at which point it'll probably get stuck and move back towards the 152 level on the ETF. Oil is in a long-term pennant pattern, trading in a relatively narrow range. Nothing too exciting here. We've had a little bit of strength the last few weeks, but again, until it breaks out of this pattern, you don't want to get too optimistic. And the VXX, which people are eager to jump into anytime there's a bit of selling pressure on the market, well, it still remains a pretty dead place to be. And this tells us that investors really aren't that fearful that anything major and negative is going to happen in the market anytime soon. So my ratings, I remain bullish, but with some caution on U.S. stocks, neutral on the Canadian market, remain bearish on gold, and neutral on oil. The U.S. markets are stalling at all-time highs and will likely pause at these levels before trying to break out. Now, if the upward trend line is broken, take a cautious stance. Canadian markets continue to lag as there is profit taking in the strong sectors and no strength in commodities. Well, that has been the Stockscores Market Minutes for March 25th, 2013. Have a great week in the market and trade well.